866-928-3310 and we'll send you out a no obligation information kit absolutely free. 866-928-3310. The CFRN Emini Futures Cast is now on Stitcher. Listen to us on your iPhone, Android phones, BlackBerry, and WebOS phones. Stitcher is smart radio for your phone. Find it in your app store or at Stitcher.com. Stitcher Smart Radio, the smarter way to listen to radio.
Are you ready, Steve? Andy? Yeah! Bert? Well, all right, fellas. Let's go!
You're listening to CFRN, the Christian Financial Radio Network.
Today's broadcast is brought to you by Audible. Get a free audiobook download at www.audibletrial.com/CFRN. Over 85,000 titles. Choose from mystery, romance, religion, science, technology, business, New York Times bestsellers, even children's books. You name it, Audible has it. With 85,000 titles to choose from, you're sure to find the perfect audiobook for yourself or to give as a gift, and it's absolutely free. Just point your browser to audibletrial.com/CFRN. That's audibletrial.com/CFRN. And become a part of the audiobook revolution by downloading your free audiobook today. audibletrial.com/CFRN.
Hey trader, want to get rich quick? Well, good luck with that. If on the other hand you actually want to learn how to trade, the place to be is www.cfrn.net. Tune in Monday through Friday, 9 a.m. Eastern for our daily devotional, and then spend the next 3 hours learning how it's done from professional traders who actually trade for a living. That's www.cfrn.net. Every trading day from 9 a.m. to 1 p.m. Eastern. CFRN, a community of believers who trade for a living.
Good afternoon, traders, and welcome back to the CFRN Emini Futures Cast. This is the daily broadcast of Indeterminate Length, where we discuss all things Emini, along with some really big ideas on the finer points of trading gold, bonds, crude, sugar, the euro, and even T-bills. Joining us today from our studios in Boston, Mr. Michael Borth. From our trading desk in Chicago, Mr. Burton Schlichter. Now, to get things started, let's go to our host and founder in Studio A, overlooking South Mountain, America's largest city park. Here's Dwayne.
Good afternoon. Welcome back for one last time this year. Welcome to the show. Thanks for joining us. So glad to have you with us. Whoever you are, wherever you are, Happy New Year's Eve. I hope I'm the first person to say that to you today. I'm sure you'll hear it many more times. Yeah, you'll probably hear the abbreviated version. Happy New Year. So what are you going to do with the day off? You going to think big thoughts, deep thoughts, work on the spreadsheet to go along with the resolutions. Do you do resolutions? Do people do that anymore? Or do we grow out of it? Do we eventually learn that it's futile and so we just back away? Anyway, Happy New Year. We're going to have a couple guests today. Well, they're not guests, really. They're just part of the family. Dr. Tom will be here. Garrett will be here. Sean will be here. You never know, Bert might pop in. It could happen. So, let's get rolling. I got a chart up of the S&P 500 Emini Futures. If you cannot see the chart, go to our homepage at cfrn.net. On the right-hand side of the page, click the big microphone, follow the instructions, You'll be registered in about 30 seconds, all the way through the end of today's program. Now, if someone could tell me, I'll finish telling you in a minute, but if you could tell me how to silence when a call comes in on a Google number that you only use that number to make outbound calls with, but sometimes someone calls you and you can never find the thing. I'm sure there's a thing. I've tried Hangouts. Hangouts doesn't seem to be the thing. So I'm trying to find a thing so that I can silence those calls. Now, those of you who are live right now, you didn't hear that. But if you're listening, you're watching via YouTube, which I'll get to in a moment, then you heard it ring. And so I need to make that go away. And I figure if I can Google up the answer, 100 of us can Google it up that much quicker. So, somebody let me know what to do, what button to push. I'll do it, and I won't have to worry with that anymore. Okay, all right. Chart up, S&P 500. Told you how to get to the website. Told you how to see the chart. You can also see the chart during the show live, youtube.com/CFRN/live. That's all there is to it. And, of course, at youtube.com/CFRN are archives of all the great shows, reaching back to, well, the ones all the way back to 2005 are on the old blog. They're not on YouTube. But going back to probably 2010, 2011, they are. 2012, somewhere in there. Whenever we started to add a video to the daily broadcast. All right. So now that you know how to, and tomorrow we're closed. No show, no live training room, no markets. The markets will be closed. And so will we. And so will you. And you'll just be with your family, and you'll look at the new year. You'll look at the year behind you. You do the retrospective thing. Or maybe that's tonight. Tonight you do the retrospect, and then tomorrow you look forward. Okay. I'll do that with you. Now, when you come back on Wednesday, you got to register for the radio program all over again. Although I think this time you'll only have to register going forward once every 2 months. I heard something about that. So whatever it is, Wednesday, got to register. Okay? Just go to the homepage at where? Yeah, CFRN.net. And then do what? On the right-hand side of the page, what are you going to do? You're going to click the big microphone, follow the instructions, boom, you'll be registered for as long as it registers you for. Okay? All right. Now, we had a gap gap higher open last night on Globex right there. So there's the Globex open. So we closed last Friday at 24.88, and then we gapped open at 24.95.50. We waited all night for the gap to close. It finally did. And as we were getting ready to leave the live training room this morning, I told everyone who was there, we had a big crowd today. Thanks, guys, for coming out. Little open house action. Good to have you with us. I said, if there's going to be a change in sentiment, in other words, I mean, Santa Claus still got a couple of hours to finish this rally. Okay, that started over here. Now we're going sideways for a few days. These are last week's weekly trading zones. Partners, passport holders got their zones this morning, 6:15 a.m. Eastern, via email in their inbox before Wall Street wakes up. And as you can see, as we powered up last week, support, 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 and a little support. Now, if anybody tells you support and resistance is dead, archaic, prehistoric, Yeah, if they say it's broke, don't believe them, okay? Because I got pretty good evidence that maybe it's not completely broken. So, as some would say, is the market out of trouble here? Oh, I don't know if it's ever in trouble, but as you can see down here on the slingshot, where are we headed? However, indicators do lag, and so could this be the turnaround that takes us to 25.40? And am I suggesting that we go to 25.40 today? No, I'm not suggesting that. I'm just suggesting that the market will eventually go there. That's all. We got that crazy idea back here at 23.75, and we were looking for a 50% fib retracement. Got a 62%, which is fine. We'll take that. I'll show you what it looks like. Showed you last week. Show you again. There we go. To the tick, as they say. And then we moved on, moved up, moved sideways, and gapped higher. The indices, almost when they gap, which typically the only time you'll see a gap is perhaps on a Sunday evening. Occasionally during earnings season, if somebody really blows out or blows up, you might see it. It's just Sunday night, you know. If you got a gap, gaps on indices almost always close. There you have it. That's all we were looking for last night on the S&P, on the Dow, on the Russell, on the NQ. We were looking for the gap to close, and it took all night, but as you can see, it finally did. It closed. Support, 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 support. Gap closed. Now, what does the logical thing look like? Okay, I couldn't agree more. And if support's still alive and well, resistance, it probably is too. So what does this create? Some might call it a sweet spot or a window of opportunity. We'll talk about that a little more later on. Right now, let me give you a little bit of news. Just a little bit. The Chief Strategy Officer at the Human Rights Foundation, Alex Gladstein, has published an article in Time magazine titled "Why Bitcoin Matters for Freedom." In this article, in Time magazine, he explains how cryptocurrency can help people retake control of their lives from oppressive regimes. He writes, speculation, fraud, and greed in the cryptocurrency and blockchain industry have overshadowed the real liberating potential of Satoshi Nakamoto's invention. For people living under authoritarian governments, Bitcoin can be a valuable financial tool as a censorship-resistant medium of exchange. His article focuses on the current situation in Venezuela as the prime example of its thesis. It details how Venezuelans are using Bitcoin to evade runaway hyperinflation and harsh capital controls. It also shows how, after greatly devaluing citizens' savings, the Maduro regime is using the banking system to confiscate much of the money sent from abroad by people that want to help their families back home. Beyond Venezuela, the article notes how Bitcoin can help citizens suffering from inflation in Zimbabwe, those who want to avoid mass surveillance in China, NGOs that have their bank accounts frozen in Russia, and refugees without access to basic banking services. It also explains that cash fiat is used without government permission, but it can be made virtually useless by hyperinflation, and that many countries are moving to become cashless societies, thus strengthening the need for cryptocurrency. Less than 1% of the world's population, no more than 40 million people, have ever used Bitcoin, but according to the Human Rights Foundation, more than 50% of the world's population lives under an authoritarian regime. Now, this is Time Magazine. If we invest the time and resources to develop user-friendly wallets, more exchanges, and better educational materials for Bitcoin, it has the potential to make a real difference for the 4 billion people, that's B as in billion, 4 billion people who can't trust their rulers or who can't access the banking system, period. For them, Bitcoin and cryptocurrencies can be a way out. There we go. We need some bell work. You take this bell, take it to the shop. Take it to the bell shop. All right. Let's look at the numbers. These are cash markets around the world. We'll start in the U.S. We'll get back to the futures in a moment. But for now, the Dow. Up 149 points on the session. NASDAQ up 30. S&P 500 up 11. Russell 2000 down 3. Now the Russell led to the downside last night. And you can see it here. Gapped. But it closed its gap early on in the 9:30 candle, in the opening candle. Closed its gap, continued down, found that same area of support. Now trying to build a leg to the upside, like so, or like so. We'll soon find out. We've got a doji right now, 22 minutes into the life of this candle. We have a doji. All right, in the commodity basket, crude oil down 10 cents, trading 45.23 last. Gold up 70 cents, trading 1283.70 last. The Asian markets, the Nikkei down 62 points at the close. Shanghai up 10, and the Hang Seng up 341, which is a little over 1.25%. In the European markets, the FTSE closed the session, closed the last trading day of the year, down 6 points. The DAX went unchanged, and the CAC posted a gain of 52 points. So there you have it on this final trading day of the year. Asian markets mixed, European markets mixed, and here at home we're still mixed until the Russell can add a couple points. Still need a couple. Okay. There you have it. A little bit of news and the numbers from around the world. Let's go to Michael, get a recap of what happened in our live training room today, and then we'll be back to talk to John and Dr. Tom and Garrett and whoever else might pop in.
It's a good crowd today.
Yeah.
I mean, we had a good crowd in the room too.
Mm-hmm.
It's good stuff. Here we go. Okay.
Okay.
You should be seeing.
Looks like it's a go. All right.
Yeah, you should be seeing my charts. Great.
Okay.
Okay. Let's bring the spreadsheet up. There we go. All right. Well, this is a big deal in the spreadsheet because it's the last day of the month. It's also the last day of the year. So let me just get started like we normally do. Excuse me. Okay, if you're going to read the spreadsheet, well, I'm sorry. Good afternoon. Today is Monday, the 31st day of December 2018. Today, if you're going to read the spreadsheet, you're going to read all the CFTC risk disclosures down at the bottom. Today is the 31st day of December, the last day of 2018. Can you believe it? We made 2 ticks in the euro, 6 ticks in crude, and 2 ticks in gold. That ended up putting us at 92.50. Today, let me bring this up. Okay. Today it took 90 minutes and 4 trades to get to the goal for the day. At that point, we're up $105 a contract, and we took a total of 6 trades. So we're going to end the month at $3,545. That's over 18 days, averaging $196 a day. That is 1 contract, 2 hours per day. We're going to end the year at $38,518. That's over 240 days, averaging $160 per day. Again, in here, if you had added 1 contract per month and did everything exactly as I did, which is highly unlikely, but did everything exactly as I did, you would now be trading 12 contracts, and your gross, if you had all the entries and exits filled with all the contracts exactly as I did, your gross would be $256,905. If you started out with 10 contracts at the beginning of the year and you just traded exactly as I did and got fills, complete fills on both ends of every trade, like I did, your gross would be $385,000. Okay. If you have not taken a free trial with us, go to the homepage at CFRN.net. Right over here in the right-hand column, it says 5-day free trial, apply.cfrn.net. If you click on that, you will be brought to this page, where all we ask for is your email, your first name, and how you found us. Hit that submit button, and you'll be sent a confirmation link. You must click on the confirmation link. Okay, if you don't click the confirmation link, we don't know you took the free trial. Okay, so on gold, we only had the 1 trade set up right here. We got 2 ticks profit on that. There was another one here that I missed, and then there wasn't one there, and there was nothing during the break. Okay, nothing during the break. On the euro, we started out, well, in the pre-market, there was some nice movement on the euro. But once we started out right here, we picked up 4 ticks on the first trade right here. Okay, then we had a break even. We missed that long. We had a break even, then we stopped out, -8 ticks. Okay, and then that put us at -4 overall. And right here, we picked up 6 ticks to put us at +2 on the morning session. Since then, there's been nothing on the euro. Okay, on the crude, we had just the 1 trade set up right here. We picked up 6 ticks on that. Let me see if I highlighted anything else. I didn't highlight anything else. Yeah, and let's see, during the break, there was a long right there and another one right there. Then it flips sides, and there was a short right there, and then it just got really choppy. So that was it during the break. The ES, you can see the weekly trading zone right here on the ES. It was totally attracted to that and kept going back to it this morning. Let's see. I only have 1 trade highlighted here, it looks like, on the ES. And I have 2 of these going the wrong way. So there must be a zone there at 94.95. But yeah, it looks like there was probably a trade right here. A short trade would have been a break even. And a shorting opportunity right there. That would have been a break even. And it had this big leg down here. That was during the break. I don't know why, but it didn't give any trade setups anyway. It pulled back up, and there would have been a short from right here that you could have gotten a few ticks off of. Then it switched directions, and it gave a short from right here that you could have made some money on. Then a long right here, when it flipped directions again. Could have made some money on that. And then the slingshot was all messed up. And we had nothing else. Okay, so we'll go back here to the spreadsheet and all that stuff. This one. Okay, well, like I said, if you have not taken the free trial, go to the homepage at CFRN.net. And right over here in the right-hand column, it says apply.cfrn.net. Click on that. When you do that, you'll be brought to this page, where all you ask for is your email, your first name, and how you found us. And you click on that submit button, and you'll be sent a confirmation link. You must click on the confirmation link, okay? Once you do that, then we know you took the trial, and we can get you into the room, into the training room in the morning. Okay, so today is the 31st day of December, as I said. And if you're going to read the spreadsheet, you read all the CFTC risk disclosures down at the bottom. Today we made 2 ticks in the euro, 6 ticks in crude, and 2 ticks in gold. That put us at 92.50 on the morning. Today it took 90 minutes and 4 trades to get to the goal for the day. At that point, we're up $105 a contract. And we took a total of 6 trades. So, I'm not even going to question it. So on the month, we were up $3,545 a contract. Okay. Now over here in the right-hand column, I have net profit with an $8 commission and net profit with a $5 commission. Okay, $23.69 or $28.10. This $35.45 is over 18 days, averaging $196 per day. On the year, we're at $38,518.75. That's how we're going to end the year. $38,518.75. That's over 240 days, averaging $160 per day. That is 1 contract, 2 hours per day. Okay, 1 contract, 2 hours per day. And that's it, guys. We're going to end the year right there, just like that. And with that, we can pass it back out to Studio A, fabulous Phoenix, Arizona, overlooking South Mountain, America's largest city park. Dwayne, if you are ready. And maybe Dwayne's not ready. Okay. He's still decouraged. Yeah, so the market's right now, guys. You know, going into the end of the year and the holiday, where I don't know what kind of movement we're going to have. I was thinking, being the last day of the year, that we would get a lot more activity today. But you know, when you look at the ES and you add volume and you put it on a higher time frame, you can see, you know, Friday's volume was much better than today's volume. We have very little volume today. I'm surprised. But either way, it is what it is. It was a decent day. And there was opportunities to be had, and money to be made across all the markets. Does anybody have any questions? Any end of the year questions? Okay. Dwayne, I believe you are back now.
I am.
I think that was you I just heard.
Indeed.
Okay. Okay. Well, we're ready to pass it over.
Okay.
Just looking at the volume on the ES compared to Friday's volume, it's about half. And I was expecting more, actually. I was expecting a big day today, but it just didn't happen.
Yeah, I would have thought there would have been probably most of the activities taking place in individual equities.
Yeah.
The Dow's up 200 points, but the futures aren't seeing, because what we're seeing in the equity markets are people making year-end adjustments to portfolios, etc. End of year tax selling, etc. And those aren't so much a thing with futures. They can be, but more so in the equity world. Okay. John make it in yet?
He wasn't just a few minutes ago. Hang on, let me go check again. I know with all the guests that we have coming on today, we're gonna need to move along. But no, not in yet.
Hey, okie doke.
Yes. Thank you, Alan.
So again, we were looking for this gap to close last night. That's really the only thing that was on our docket much. except there was this, which is copper. And on copper, the Logic 247 alert was, stand by. Just split it, Michael.
Okay, Dwayne. I'll do that for you right now.
Hang on, guys. I'll bring it up. There we go. Okay, yeah. Copper was 268.35 down to 267.35. And we put in a swing low at around 263.35. So that's 6 cents at $250 per penny. When I can, I like to just round it to 268 to 267 to 266, $250 increments. Now, this blew, you know, right through the target. So I just want to show you, and this holds true for any extended move on any of the alerts, whether it's a Concierge Trade Alert, a Logic 247 alert. You just now let me put the target in there. 26735. Sort of straight line. Yeah, there we go. Okay. And then the entry was back up here at 835, which is right there. There we go. So from there to there, it's $250 per contract. Okay. Now, nothing wrong with $250 per contract. However, when you lay the indicators on, you spend a lot of time patiently waiting for the market to hand you an opportunity such as this. So again, from the entry to the target, $250 per contract, 1 penny, a 1 penny move in the price. Nothing wrong with that. However, you're short. When you hit that target, you're in a short position. Your indicators are red and falling, red and falling. You're below the BBC. We wouldn't be in a short position unless we were below. And so you have to ask yourself, as this rips through the target and continues down, why get out of a perfectly good trading vehicle? I mean, you can't ask for better than this. When we put this on, did we anticipate this? Not really. We were definitely looking for this because that was the target, but it clearly says, and trail if possible. Okay, well, as long as price stays on this side of the red CFMA1, and we're going to stay with it even through this big up candle. Now as we zero in here, let's take a little look. In order to exit, we need two things to happen. We need the step line to cross over, and then on a short trade, we need a green candle to close above the step line. The step line needs to cross over, and then we need a green candle to close above it. Could that be this candle? It certainly could, because we've crossed over. So if this candle closes green, above that step line, at that price, take your exit. That's the market telling you that price is about to walk sideways and potentially change course. If it closes red, then logic would tell us that we'll go down to test these lows and potentially probe lower. Are there fundamental reasons behind why copper dropped a nickel, 6 cents in this session? I'm sure there are. Probably perfectly good ones. I could not tell you what they are. Now, one of our guests coming on, John, Dr. Tom, Garrett, they might could tell you the fundamental reasons. I don't know. We could look it up. I'm sure it's out there somewhere. Somebody's hung something on, somebody's pinned a tail on that donkey. But all we know is we had a bearish cross. And when that happens and we're red and falling here, we just want to get short in an equitable position to our target. And then if market conditions encourage, and this is encouragement, it doesn't get any more encouraging than this. How many red candles you got in a row? 1, 2, 3, 4, 5, 6, 7, 8. So this is opportunity in the market, and that's what Logic 247 is all about. It's about finding opportunity in the market across all the futures markets and then presenting them to you in an easy to digest format in the Telegram channel. Trading's not easy, but it just got real simple. All right, let's see if John's here, or Tom, or Garrett, or anybody.
Nope, John's not here.
John's not here. I told him.
No.
Don't come late. All right,
let me check.
Garrett here? I forget
let me check
door Garrett comes through.
Yeah, I know. That's why I'm looking in both doors right now. He's not in the back door, our door.
Okay. All right.
But I don't see him.
Okay.
I don't see him. And I don't see John. And I don't see Dr. Tom.
They'll be here. They'll all come rushing the door at the same time.
Probably.
Okay, so back to the S&P. We're looking to see if we're going to be able to... Now what would prevent? Wait, what could possibly prevent? Let me show you. Right there. Right down to last week's weekly trading zone. John just rang my phone. I think he might be here.
Yep, he is. I can open up his mic.
Okay.
There we go. His mic's open.
Hey, John. Welcome to the show.
Hi there. How are you?
Good. Happy New Year.
You too. Happy New Year to you. It's already New Year in Australia and China and a few other places. So,
yeah, it is. It is.
I just actually put out a couple of tweets this morning that it doesn't look like it's going to happen at the moment, but if we did have a late sell-off today and gap down, year over year, in other words, if we were to open sharply lower on Wednesday, which is something that can't be ruled out, I think there's some industrial news probably going to come out in China and maybe even Europe on the Wednesday, possibly. If that news was particularly negative, which it probably would be, it could happen. We might be looking at the opposite of what happened in 2011. In other words, even 2015-16, which, if you remember, I think that might have been a gap down here actually, from 15 to 16, because remember the year opened and sold off immediately. The bad news is the UK market has had the worst year since 2008, and the the U.S. probably heading the same way. That's not a very good way to end the year. Now, the chart you just pulled up,
this is weekly on the
it's kind
S&P.
of encouraging because you know we've put in a bottom down there, and you know we could be looking at something a little bit like 2015-16 if you go to the left and see the previous bottoms. We've just got a larger bottom scale, if you like. You know, if this is I'm just thinking about this. You know, we talked a lot during the year about the possibility of what I called 87 light. Okay. I think you could call what's happened so far this year to be 87 light. In other words, it's about half as bad as 87 in terms of where we are today. What's interesting about 87, and this is very intuitive, it's worth considering, you know, what happened is that from 84 and a half, 85, from 1984 and a half, 85, you know, the market got wind of the tax cuts back then and went on a tremendous tear to the upside. And very similar to really what's happened since 2009. You know, we had 1980, which was a very bad year, and then we had 1982, which was even worse. You know, going all the way down to, we actually got down to I think it was 769 at the low. 777 is a famous number right before it came up. We went up to 1403, but then 1400 rather, and then we kind of corrected for a few months, and then we took off in 85 and went on a tremendous tear. 86 was a big up year, and 87 was a huge up year. You know, 30%. We had a 10% correction in early 87. And then we had two of them, actually. We had one in March, April, and one in April, May. And then from May through the summer of to the 24th of August, I think it was, we went up about 30%. You know, not unlike what happened in 2017. So we are going through the motions of an 87. But the reason I'm bringing this up is the 87, I mean, it really lasted from August through December. I mean, after December, the market started recovering, and we went from 1650 on the Dow all the way back to 3,000. You know, within so that was 1988, 1989, 90. So in 2 years, 2.5 years, and one of the leading markets at the time was the transports, which I might add has really not been beaten down too badly from where it is today. And we need to watch the transports very closely, because if this is one of these market corrections that doesn't turn into a economic correction, if you like, or recession or anything like that, and the economy keeps going, because that's what happened in 87. We never really had a recession after 87, in spite of the severity of the crash. It's worth keeping that in mind, because if the market recovers, and actually looking at your chart, you know, we've had a kind of a bigger C correction than we expected, but not unlike 2009. You know, as I said before, if you go back to that chart you were looking at earlier on, the S&P, it's kind of like a microcosm of what happened from what happened from 2000. If you look at that, you know, the October correction is like 2000. The January February correction is like 2000. Then we made a new high, just like we did in 2007, and we had a very similar kind of ascent from the 2003, and then we had the 2009 crash. And I think we've had a kind of a 2009 crash similarly here, a bit overdone, but not that can potentially recover from. I mean, if this thing suddenly took off in the new year, and it could, and we start getting back over 2,600 in the S&P, and get, hold above 26 and start building back, and to our view of this, which is potentially new all-time highs next year and going into 2020, I mean, it would be the best of all worlds. And I think the Fed has taken a real beating, not just from Trump, but from pretty much all the hierarchy of the financial world. I mean, there isn't anybody out there saying raise rates. And the bond market is, look at the bond market today. I mean, the bond market is screaming at the Fed to lower rates. I mean, they're not getting the memo, these guys. They're not paying attention. If the bond market was at 136, you could say the Fed is probably right, but the bond market is telling them they're wrong, and they ought to wake up pretty fast. They ought to wake up to that. And look, if they start lowering rates sometime in the first quarter, maybe even at the next meeting, or don't raise rates, that will be step one. If they didn't raise rates the next meeting, and then maybe lower rates the meeting after that, that could be really that could be the game changer. And we said it here on this show. Remember I said first or second, third quarter, they should be lowering rates, and they need to get on with it, because the quicker they lower rates, the quicker this market's gonna get back on track. Incidentally, there was some very interesting stuff that I uncovered over the weekend.
You need to get that? You need to get that?
No, it's okay. That over the weekend, that there is this has been that that selling climax we had last week was one like almost an all-time record climax. I don't think there's ever been a selling climax like it. It really was. You're
talking about epic. On the 28th?
Yeah, exactly. Yeah. This, and that huge reversal. It had staggered. Okay, let me just get this.
Yep. Dr. Tom, welcome to the show. Oh,
his mic is open, but
okay.
I can't
stepped away.
And I don't see Garrett.
Okay.
Right now either.
He's probably on the phone.
Okay. All right. Got 5 people in the staff. That's unusual.
Now the Dow. Take a look at this, guys. We haven't looked at the Dow yet. Gap not closed.
Okay, can you hear me now?
I can hear you now.
There you go.
Okay.
Now we can hear Dr.
Happy
Tom.
New Year.
Happy New Year to everybody. How you doing, Mike?
Happy New Year to all of you. I'm doing all right.
Hello.
Hey, John.
Right,
Dr. Tom joined us.
Hello.
I said hello, John. Dr. Tom joined us.
Oh, good morning, Dr. Tom. How are you?
I'm doing fine, sir. How you been doing? Happy New Year.
Happy New Year to you. And I was actually just about to tell Dwayne that we were talking about the possibility of a gap up or down in the markets. But, I think you and I, even when we were on before, I laid out the similarities between what's happening in gold this year to what happened in the markets in 2011. And, what happens in the market sooner or later happens to gold, because gold is the hangover, is the market hangover that inures in favor of the gold. And, sometimes it's a few years afterwards, and sometimes it's, a cycle afterwards. It could be 7 or 8 years. And it's very important to grasp this, because as I explained, just to recap, it's an incredible coincidence, but when we bottomed in 2009, in March 2009, March the 6th, we had the biggest short interest in history at the time in the New York stock market. And then we went up for a couple of years, pretty fast. We made new all-time highs in the transports and the mid-cap in 2011, in July 2011, but we didn't, wasn't confirmed by the rest of the market, which is something we predicted as early as April 2009, even March, actually late March, and it came true. But then we had a very hard correction, a little bit like what happened in gold earlier this year, where we fell from the 1360 all the way down to 1160, a couple of $100. We had almost a 20% correction in 20 days back in 2011. It bottomed on October the 4th. Very interesting date-wise, because that's when the gold started taking off this year. So we're kind of pacing out with a gap of 7 years what happened in the stock market. What's happening in gold this year happened in the stock market in late 2011. But here's the other thing. We had record all-time short interest in gold and silver in the last few months. And guess what? On October the 4th of 2011, we had even higher short interest than we had in 2009. And you have to scratch your head and you say, well, how can the market be so much higher and yet people were more negative? You know, the short interest was greater. Don't ask me, but it just happens that way. And actually, you know, it happens because, remember, in the first few years of recovery, the economy was bleak. There were lots of stores boarded up, and there was little action in a lot of the towns and cities in America. And people like that guy who co-founded or who invested in Facebook early, I forget his name now.
Which one? Peter Thiel?
Yeah, Peter Thiel.
Thiel, yeah.
Listen, he made $7 billion, and I'm not kidding you. He lost about $6 billion shorting the market from 2009 to 2011. Seriously. So it's people like him who thought that, you know, the end of the world. Remember, we were in a major crash, depression kind of lows, and there was a lot of people still shorting the market. And when we had that 20% hit in 2011, you know, more people piled on the short side than ever, just the same as they did in gold recently. I'm happy to report that the short interest is a lot less today in the gold than it was a few months ago, just the same as it was going into the end of 2011. And the other thing is, looking at the markets today, we've got silver closing on the high of a 6-month high. We've got gold closing almost at a 6-month high going into the end of the year. And what happened in 2011 with equities was we gapped higher. I think that was the year of a shutdown, and they resolved the shutdown right before the end of the year. And so we started off 2012 with a gap opening. It's very, very rare to have a year gapping higher, you know, with a gap. It's just the most bullish thing in the universe when that happens. Well, what happened next? The market went up for pretty much 7 years straight in one of the most spectacular bull markets of all time. And I believe the same thing is about to happen with gold and silver right now. If we gap higher into 2019 on Wednesday in the gold and silver, you better buy it, because if it keeps going, it probably never fill that gap, probably maybe in the rest of our lifetimes. So the upside on gold and silver is, in my view, meteoric. It's as good as it was from 1976 through 1980. You know, gold didn't really take off until 1979, which to me is 2019. And so, you know, we could have a huge up year in gold and silver next year. Remember what happened with Bitcoin? It went from 1,000 to 20,000 in about 18 months or less, and they're looking for another Bitcoin to get behind. I got a report out of China over the weekend, and you know, the real estate's been the big thing in China, but all these ghost cities and everything are really starting to. The real estate is in danger of crashing, and they're looking around for something to get into, and gold is it. Chinese are buying gold. The Northern Irish are buying gold because of the Brexit. The gold market is, look, the Russians have been buying gold. Chinese have been buying gold. The market is very tight. That's why the price is going up. The commercials are longer than they've ever been in their lifetimes. What does that tell you? These are the guys who need to buy gold. They need to buy in the future to lock their prices in. They're maxed out on the upside. The fundamentals almost couldn't be better for gold and silver right now. And the Fed starts lowering, if the Fed goes to quantitative easing in the next, quarter or two, it could have a very dramatic impact on gold. And once that momentum starts going, look, the Chinese, even if they make a deal here in the next 60 days or so, and they're probably going to weaken their currency further. The more they weaken the currency, the Chinese can't move the money out of the country like they used to be able to. The only hedge is gold. And these guys, the guy was telling me, he said, look, he said people are just nuts about gold in China. They're obsessed with it. They're obsessed with gold in China. They're obsessed with gold in India. The Russians are buying a huge amount of gold. We must be getting to a situation where there's just no more gold, and if the sellers sense, as they're starting to, that the price is going higher, why would they ever sell at today's prices? Why would you want to sell something that's closing on the high of the year? Usually when you get a yearly high, it tends to go higher, and it could go a lot higher. You've got very smart people like this Egyptian billionaire who's got more than half his net worth of $3 billion in gold. These are the smartest money out there. You've got people like Jeffrey Gundlach who believe gold could go to 2,400. Silver silver gets back in the 20s. Katie barred the door. There'll be no stopping this. JP Morgan have cornered more silver today than the Hunt brothers did. The multiples of what the Hunt brothers did in 1980. They want the big payoff down the road. So all this, if you think about what I've said now, and the similarities to what happened in the stock market went up for 7 years. In a spectacular manner, multiple gains. Here we are at 1285. We have the potential to go to 3600, maybe 4200. It's probably going to go higher than anybody thinks now, because
there's quite a few people calling for $5,000 gold.
I would agree with you, because they've been beaten. The bullishness has been beaten out of the gold. Even the most bullish guys on the planet have kind of got second thoughts about it. And most people have missed this rally because the way it's been going up and down, very classic pre-bullish kind of early momentum, and the shorts have been completely fooled, because every time it goes up, it goes down again, and they think, oh, I'm not going to cover. I'm going to hold. But now we're kind of at a point, in my view, where we could accelerate to the upside in a very spectacular way. Literally a multi-$100 cent in gold and a multi-dollar cent in silver could just happen. And look, traditionally, the first quarter of the year has been very good for gold, even in the bear market we've been in for the last 6 or 7 years.
Garrett, you mentioned about China's interest in gold. Here's a few fun facts about China. Not that many years ago, the world's biggest producer of gold was South Africa, right?
Mm-hmm.
Right. China took over that position, I think, about 3 years ago.
Mm-hmm.
India was the biggest net importer of gold.
Mm-hmm.
Now that's China. But the thing about China is that they've been very secretive. There was one reporter 4 or 5 years ago in the Financial Times that busted China, what they were reporting to the IMF as far as their gold holdings were only about 20% of the real gold holdings.
Mm-hmm.
And so their finance minister admitted that they had what they had, and said they planned to quintuple that.
Mm-hmm.
And so China is going to be a huge driver of this, because, I live in West Palm Beach, 2 or 3 hours away from Orlando. For the last 30 years, the biggest gold show in the world has been in Orlando. And guess where it is today? in Beijing.
Well,
it's in Beijing. And the Chinese have done one really smart thing that the United States did the opposite of. We were really dumb. After the gold confiscation in 1933, we made it illegal for citizens to own bullion. And that was over 40 years. You could actually go to jail for owning bullion. You could own gold jewelry. You could own collectible coins, but not bullion. The Chinese government for the last almost 10 years now has been actively encouraging their citizens to buy gold. So they're like no other country in the world. About half the gold that's in the country is owned by individual citizens. So in effect, the Chinese government has twice as much, being a totalitarian government, they own what the people own, right?
Right.
So they own twice as much gold as they're reporting.
Well, I have a theory about this thing with China, and I think it makes sense. When they came out a few years ago, it was near the bottom, and they increased their position to about 1,800 tons or so, officially.
John?
Yep.
Let me welcome Garrett to the show. He's here. Garrett, welcome to the show. Happy New Year.
Happy New Year.
Yeah.
Sounds like you're having an interesting conversation there.
We are, and I want you to weigh in on it in just a second. John, finish your thought.
So, interestingly, the Russians and the Chinese are supposedly equal about right now, 1840 or something like that, tons each. So there could be a bit of rivalry going on with these two in the next era, where they might step it up, to try and get ahead of each other. That's the first thing. But I believe that when China announced this increase, it did so kind of judiciously, or not rather surreptitiously as well, because they didn't want to give away, they didn't want to end up with egg over their face if they say that they doubled their position in gold and then the gold went down, they might have not looked so smart, right? But the fact that, ever since they actually put that out, the gold has gradually gone higher, and it's it actually went quite a bit higher, that I think at some point in this coming year, if it emerges that China suddenly has, whether they raise it to 2,500 or 2,300 or 3,000, whatever the number is, even a few hundred tons, even up above 2,000, could have a very dramatic impact on the gold market in the short term. And I would say this, there was a time when India purchased a couple of hundred tons of gold, and I think I remember gold going up $200 like really, really quickly. So I think any of these big players like Russia, China, India, for every 100 tons they purchase, you can almost say the gold is going to go up about $100, and that may become more routine if we start really going up a lot quicker, because I think ultimately I think we're looking at a replay of the 70s here, of 1979, 70s, 1979, 80, but it's not the Hunt brothers cornering the silver market. It's whole countries cornering the gold and silver markets for their own, for their own protection and for their own, intentions. So, and down the road, if it gets, look at the dollar today. Finally, this dollar is starting to crack, and that's really the key to the whole thing. If the dollar gaps down on Wednesday, I think that would be a very welcome development. If the gold gaps up on Wednesday, that will be huge. So, and I think that the dollar is in danger of accelerating to the downside quite rapidly here in the first month or two of the new year. This is what happened in 2015-16, and there was a few days in the new year, a couple of days into the new year, the dollar held up and everybody thought it was going higher, and then all of a sudden it cracked and it really went down very, very substantially. Excuse me, before this rally started over the last year or so. Now, it's certainly overdue for a sell-off, and I think the next sell-off will be devastating to the US dollar. It'd be very good for US business and economics. It'd be good for the stock market. It'll be great for the precious metals. It'd be great for assets, for all asset prices. And that's one of the reasons why you've got to be potentially bullish on gold and stocks together, and a potentially inflationary environment here unfolding over the next couple of years, or maybe even the next 5 years, that could result in the mother of all bull markets in gold and silver. That could be just about to begin in what I believe is accelerated up phase. So I'll let you.
That would do good for my business, but I'm sure you're aware of this, or have heard this, but all the gold that's ever been mined in the history of the world and all the known reserves would fit in 2 Olympic-sized swimming pools. Mm-hmm. Now, when I first heard that, I didn't believe it. And I researched and researched and researched. Everywhere I went, it was confirmed. Another way of looking at it is all the gold ever mined and in reserves would be a cube 30 meters on all sides. Now that's not a lot.
A 30-meter cube.
A 30-meter cube. 30 meters is about 2 tractor trailers end to end.
Wow.
2 tractor trailers end to end. Okay.
Dwayne, I'm going to have to leave here fairly quickly.
Well, share with us what you think.
Well, I don't have much experience in this. I've only started looking at gold in the late '60s, so I may not belong in this conversation.
Okay. All right.
Who's the other gentleman on the line?
Dr. Tom. I think you met him before.
I just don't know if you call me a gentleman or not, but
I call everybody a gentleman because it's always in comparison to myself. So,
I see.
Anyway,
Garrett, we were praising your prescience there earlier on, myself and Dwayne, because I reminded him of the number of times we'd been on, and you were telling people, be ready to get out at the top, because you'd seen about half a dozen times in your career where everybody got left holding the bag and rode it all the way down to the bottom. And it's sort of deja vu all over again.
Yeah, thank you. It's funny, my seasonality this year. I'm a little conflicted in being a technical guy. I don't like to think too much about fundamentals because they tend to have a tendency to mess up your thinking. However, one of the great fundamental situations that I saw in tweets recently from the president are that these talks with China are going well, and I think that dynamic is enough to make for a pretty good market. And yet I'm conflicted because I think something is likely to happen fairly quickly there, and yet my technical work says that we have another move down to a lower low in the February, possibly March timeframe. Then I'm looking for a multi-month bull market, and I'll finish it with, I believe that this year will close lower, if not substantially lower, than where it began. So just on the market,
2019.
Yeah, I haven't had a top projection in the market on my long-term stuff. I mean, a major one. I had one in 2015 and some minor ones, but I haven't had one like I got in 2007 since 2007, and it's coming up this year. So I don't know. I mean, it's a turn date. The funny thing is when you get there, it can be something other than what you expected. But I think it's going to be a top. In 2007, I had it on. It literally came in on July 19th, and it's generally not that. It's hard to get things get specific down to a date. But it was price and time on the 19th, and I wrote an issue of, I wrote a special alert on the 17th and said, I think the market will top in 2 days, which is a fairly stupid thing to do. I mean, unless you're very certain of that. But I'd never had things come together like that, and it did top 2 days later. And I think I mentioned in that write-up that I had another turn date in early October. So my assumption was, well, you know, it's a summer top in July, and you have a bottom in October. Well, what happened is the market, you know, had a sharp down move in July and into August, and then it turned around and had a sharp move up. So by the time we were in late September and approaching October, it was pretty clear that that October date would be a top. And I wrote something on October 5th that stating that I expected the market to top the next week, and that came in. So those two turn dates were pretty substantial, and I've got them coming up this year. I don't want to mention when those are yet, because it's premature, and we've got a lot of things to think about between now and then. Back on the gold, I was going to mention, I think John was talking about late 79, and that was certainly memorable. That was the late 70s and that early 80 period was the most fun time for me in my career. The early 70s were probably the most challenging, because I started with Merrill Lynch and started to do South African gold shares, and no one was doing gold. I mean, nobody. Absolutely nobody at Merrill Lynch, and I was at their large San Francisco office, and they were trying to talk me out of that every day. And I was buying these, I was buying these stocks in a country that in those days, I don't want to say nobody ever heard of. I mean, they knew where South Africa was, but they're really, remember in 1969, we had a real surplus, and I think that was our last real surplus. President Clinton was fairly creative in order to get his surplus, but anyhow, you know, we were number one in the world. It took the next almost 20 countries combined GDP to match ours in 1970. So it was a real different time. I mean, we were number one in everything, including education and manufacturing. And we're, I don't know what we are in manufacturing.
They won't even let us on the list.
I don't even know if we're on the list, and we're pretty close to being off the list in education too. So when you, and there's a lesson there, when you go down in education from number one, and when you go down from number one in manufacturing, you are doing something very wrong. Something is very wrong in your society. In other words, you know, if you were back in the great Roman Empire, you'd know that you were after the peak. When that's happening,
you know, a couple of countries that showed us the way. They're called Venezuela and Argentina. You know.
Yeah, I mean, we've got so many lessons. Germany too, for that matter. Look at Deutsche Bank. Deutsche Bank was, I think, $160, $158 a share, and it got down to below $7. I mean, you see, that's the canary in the. The canary in the mine, you know. John had mentioned 70, you know, the late 70s, which again, that was runaway inflation. So that the runaway inflation is the most ideal scenario if you want to make gold prices go up, and that was the ideal. Now in the late 60s, and we know Nixon closed the gold window in 71, and by the way, he was correct in doing that. You know why? I mean, you know, people say, well, you know, he ruined our, you know, we're no longer back. You know, we haven't been back for a long time in reality. But Nixon, what Nixon did was correct, and the reason it was correct is that we externally offered gold in exchange for our greenbacks at $35 an ounce, and rumor had it at that time that France was sending over a large barge with a lot of greenbacks looking for us to, you know, empty Fort Knox. So, you know, he made the right move. Otherwise, we would, and then, you know, that led to the petrodollar, because, you know, without that, we ran the risk of, you know, we were the savior after World War II financially, and we ran the risk of losing.
This Dr. Tom, at the time, the price of gold that we were obligated to redeem our greenbacks was totally artificially set by Congress, and the world price of gold at that time, the market price was over $200. So
no, it was not at that time. Not when Nixon did that. We had a two-tiered market, and it started into its two-tier thing. But you didn't. The highest that you reached was in 1974. Toward the end of the year, and you reached $196. It then fell to about $103 or $104 in August of 1975. So you had roughly a 50% correction. The gold stocks topped in about August. They topped earlier, August or September.
He was selling it considerably below the market price. So I'm agreeing with you. It was a very wise move for him to make, because we would have bled the rest of our gold out.
Oh yeah, I mean, it was insane to have done that. And, you know, that was said in 1934, and had stayed, you know, remained, as you mentioned, had remained at that price for a long time. There's so that was a good move. But the important thing to remember, you know, I mean, if I had, you know, $100 bill for every prediction of 5,000 for gold that I've heard, I'd have a whole lot of them. I've heard that every single time that gold's rallied. You know, they've come down. One of these days, it's probably going to be right. But the thing that I think we've got to be aware of, there's a couple of things. Dr. Tom mentioned that thing about a couple of Olympic-sized swimming pools, and I've heard that for a long time. But the what we all have to remember is those things become folklore. You know, you hear that, and it's very difficult to truly research that. Number one. Number two, there's a massive amount of gold. I mean, we just started. Think of us. I mean, I got involved in gold in the late '60s, as far as, you know, really becoming aware of it, and then. So and there were very few people, I mean, literally you could count them on one hand, who were in the market and interested in gold at that time. I mean, there was Jim Dines, and there were a couple of publications, the South African Mining Journal, but to find anybody in the United States literally in 1970 who was interested in gold, that had any type of following at all. I mean, you had a few people that, you know, were ready to head for the hills and owned Dobermans and had a lot of canned food. And, you know, that there were some people like that, but you couldn't find anybody in any of the major brokerage houses that had any interest in gold at that time, because there was really no reason to. It had been, you know, pegged at $35 an ounce for such a long time. But couple of cautionary things. The thing I was going to mention, the Chinese dynasties that go. I mean, remember, our focal point is beyond 1970. Most people who got interested in gold and call themselves old timers got interested in the late 70s move, which was that move that began in literally 76 in August at about 103 and went up to about 877 at the peak in January. And I remember that one clearly, because we made a very nervous sell on that day. So anyway, but the point is, that was a runaway inflation, and that is the ideal time for gold. That's your wave 3 movement. You know, that's where everybody gets on it, because not only do you have the reasons that you're buying gold in the first place, which may be a weakened dollar, maybe runaway inflation, maybe a lot of things, but you've got the economy, you know, behind that as well. I mean, there was motivation to move in that direction. Now we're coming into a time period where the next big move, I mean, there's a big argument on this. Oh, it's going to be inflation, it's going to be deflation. And the answer is, I don't know, but if I had to make a bet on that, it's deflation. I mean, think about it. We had that comment that comes up every now and again from me is every 40 years or so something bad happens. Every 80 years or so something really bad happens. And interestingly, your low in the economy, your stock market low was 1932, but the market always leads the economy. The economic low was in 1933. Probably when they closed the banks. I mean, that's where I would peg it, but I mean, I'm sure that's open for discussion. But if you add 40 years onto 33, you get 73. And 1973 was the year of the top. It was ushering in the Watergate situation with Nixon. The market topped in January of 73, and you had the worst recession that you had since the Great Depression, and it lasted. It ended in 74, but a lot of companies didn't recover until the late 70s, early 80s. And then you had another one, 81 and 82, when they thought we would have a depression. So if you take 40 years and you add it to 1974, you know, you get 2014, and we're beyond that. But if you add it to 1982, you get 2022. So if you average those two, we're right in that window right now. Now, I think we might be able to get a new high in the market, but you know, we'll have to see. But the one thing I was concerned about that I would bring up is that the other thing that I think is hiding, you know, the 800-pound gorilla in the room that's hiding, is that what I mentioned about Deutsche Bank. You're going to have a situation with the banks. We're starting to see real estate fall already. I saw a chart very recently that showed 90% of all asset classes were down, which was interesting. I've got to dig that up again. But you've got a huge potential deflation, because if we're going to follow the cycle that what I call the cycle of mankind, if we're going to continue to follow that, and I'm open for change, but if we do follow it, then deflation is the big picture thing coming up. And there's a couple of things. The Chinese dynasties and probably some of the very older Indian families as well have a whole lot of gold that's been acquired for 5,000 years, you know, for a long time, that's kind of been off the market gold. It's never really moved into the market. So that's where I think the supposed supply that all these people do in folklore statements are there. I mean, I think that statement for, you know, the open market where gold is traded, you know, may still be kind of valid, but it's a difficult one. You know, it creates a mindset that fulfills an end. And the end is, hey, I'm in the business of selling gold, so this is a great story. This is a great story. And I'm not saying that it's not necessarily true, but I wouldn't want to be the guy if somebody that said, prove it to me. You know, I wouldn't want to be that guy.
I think your cycles are right on, Garrett, because I tend to agree with you. I think 22 is a really big year for a lot of reasons. If Trump gets reelected and we have a couple of years of honeymoon, that will be the top, and just like kind of was in '87 for Reagan, and then 22, 23 could be very rough, but they could also signal a peak in the metals, because the 7-year cycle up from 2016 peak in the dollar could be, the dollar could be bottoming in 2023, 24, sometime around then. So, and it's interesting you've highlighted the 73 to 82, because that was the inflationary period. So if you extrapolate out to where we are today, you know, we're in a stealth inflationary period right now, where you know, maybe the years are a bit off. You had the 2011 peak, but think about this. What I was trying to say earlier on, which I wasn't really able to clarify, is I highlighted the fact that, you know, this is sort of like 87 light, this pullback that we've had this year. And I agree with you about a lower low that could come in in February, or sometime in early in 19, and then we could have a monumental run to the upside. And there's a lot of and that could be on a weaker dollar. Look, if the dollar goes down 10 or 20%, that's an automatic lift in stock prices of 10 or 20%. So if we had a, you know, we had a sort of a 30% lift in prices between now and 2020, could get us to you know, about 10,000. I'm looking for basically a 10,000 Dow up move from the low recent lows, or from somewhere, you know, from somewhere in the low 20,000s up to about 32, 33,000. If they can time it right, could come in right on the 2020, you know, November 2020. Now, and I think in the next cycle, you know, the next presidential cycle, that's when the inflation could really start to come in pretty strongly. And look, when the dollar gets, I think if the dollar breaks from here and really starts cutting to new lows, it's going to be, there's definitely going to be a devastating fall for all the reasons you just said. You know, the U.S. is falling behind in a lot of areas, and the dollar's going to catch up with it. You've also got the Chinese and the Russians and other people trying to get out of trading in dollars wherever they can. That could really come to pass in the next few years, which could devalue the dollar. So there's and look, you know, there's at least you know, I've got an 83, 85 target minimum, more like 75, possibly even 65. If you go back and look at the dollar cycles, there's almost always a 50% drop in the value of the dollar from peak to trough. And that would equate to, you know, monumentally higher gold prices. The other reason is this. Look, the 87 was, I was trying to explain, the 87 was really a 6-month correction. And right after that, we not only went to new all-time highs in 1990, but after another short pullback, we had a 9-year bull market. We had a back-to-back bull market that nobody saw coming. You know, I've mentioned this on the show before. Robert Farrell, who was the chief strategist at Merrill Lynch, when they asked him what the 90s were going to be like, he said a boring decade of anemic growth. He couldn't have been more wrong.
Bob.
Right.
Yeah,
by the way,
I worked for him.
Right.
I was in his department. That was, what a guy. Yeah. He was terrific.
Were you on the desk? Were you on the desk in '99 or 2000 on that Merrill Lynch desk?
No, this was back in 1970.
Okay. Did you ever run into a guy called Alan Yeep?
Alan Heap?
No, Alan Yeep, Y-E-A-P.
No, I don't. But again, I was back there.
Yeah.
You know, when that department was just, you know, and they were just starting to they had a performance measurement department as well, where they were just starting to do all that stuff. And Farrell had, you know, it was I was in a program where I was lucky to be able to kind of go to and work in the departments that I was interested in working in, and I went to the fundamental analysis department, and it was, and when I got there, they said, "Oh boy, you're lucky to come to work in our department because this is where all the answers are. You know, we do all the fundamental analysis, blah blah blah." And then I went over to the technical department, which was much smaller department. I mean, there wasn't any interest in technical analysis then. Heck, there's hardly any interest now, right? No, I mean, no, it's grown dramatically, but there really wasn't too much. You know, it was hard to find any wirehouse that spoke highly of technical analysis, and it probably still is. But at the time, then when I went over to Farrell's department, they said, "Hey, this is where you really find out what's going on." So both of them were saying this, you know, the battle that exists today existed then as well. But that was a fabulous place, and I worked with a bunch of guys who went on to be heads of other companies' technical analysis departments. But,
hey, let me throw something out here to you guys,
Please.
just to get everybody's thoughts on this. When do you think the U.S. loses status as the WRC?
I'm sorry, I missed what you said.
When do you think that the U.S. will lose its status as the WRC?
You know, I don't know, but I do think that's very important, and I think it's going to be sooner rather than later. And that's a really good question, and it's a key question because, you know, there's a whole lot of things going on here that aren't in the news. I mean, the biggest thing that we have right now as Americans. And as Christian Americans, is that everything that was fought for us a long time ago is in the process of being systematically removed. And I'm talking about our freedom, mostly our freedom, what our founding fathers did. I mean, kids in school today, I don't even think they learn about the founding fathers. I mean, they try to avoid it. You know, because it's about, well, gosh, it's about freedom. And, oh, my goodness, there were some white Christians there. Oh, what could be worse than a white Christian, for crying out loud? I mean, it's just, the minds of people.
A male
have been,
white Christian.
Yeah, male. There you go. A male white Christian who's not gay. Holy smokes. That's horrible. You know, anyway, but I mean, that's the type of mentality and the type of poison that's been foisted upon us. And it's hit. And I've mentioned time and again, and the main thing that they've done, though, as bad as they've poisoned our minds, the worst thing that they've done, and they've done this via our food, they've done it via drugs, recreational and otherwise, and in many different ways, and that is they have successfully removed our collective ability to think. And again, when I bring up the words collective, when you've got a group of people, whoever they may be, that invisible group out there that comes in and talks about collective rights, that's a hint. There's so many hints. I mean, John, you know, you mentioned Venezuela, and now I think Germany's the one you really got to watch, because if Deutsche Bank goes down, you know, we've got a problem. But I mean, I got off point there a little bit. But what I wanted to say is, they've gone in and they've really changed and taken away our ability to think. And that's the scary part. I mean, they've taken away the education about the founding fathers, and they talk about things that sound good. See, so we're so soft-minded that when they talk about collective rights, and they go, oh gosh, and look at this gal, this Ocasio gal. She's classic. She's probably a nice person. She probably means well. She's probably a great neighbor. She's probably somebody who'd be your friend if you lived next door to her and you knew her. And she probably means well, but she doesn't have the ability to think. And I mean that in a nice way. I mean, she's grown up where that's been the thing. Few others do either. And the problem is they talk collective rights. See, and they sell these young minds on that. Well, gee, we have to do what's good for all of us, don't we? This is good for everyone. And obviously, You know, there's nothing out there that's, in a sense, that's good for everything other than water and oxygen. You know, I mean, it's not everybody's going to be able to play center for the Lakers. I'm sorry, it isn't going to happen. You don't get to be the quarterback for Green Bay. There's a whole lot of things that all of us don't get to do. So talking about collective rights is garbage. What you talk about is what the founding fathers talk about. You talk about individual rights, because with an individual right, now you can have something. That's my right to free speech. Pardon me. It's my turn. I get to speak now. That's my right to liberty. That's my right to this. And that's an individual right. When you talk about collective rights, guess what happens? You bring these people over, they buy into the thing, and they have a name. These people who believe that are called useful idiots, because we cannot lose our freedom unless we choose to give it up. And a great percentage of this country, 50%, is choosing to give up freedom. They're going after this Ocasio girl. They're going after that Indian lady out of Boston. What's her name? Pocahontas.
Pocahontas.
There you go. That's the one. And they're going after Bernie Sanders. And none of these people all mean well. But they're either corrupt and they've been bought out, or they're just not very smart in reality in terms of freedom. And it's all about
useful idiots, Garrett.
Useful idiots. Yeah.
My webmaster is getting his doctorate right now, and his thesis was useful drones, and it fits right in with what you're talking about. He describes our school system as like a factory churning out useful drones, workers, people who will obey, people who will comply, like the Japanese worker. That our school system is turning out little robots, and this is why I never allowed my daughter to set foot in a public school. We've homeschooled her all the way along, and right now she's going to Liberty University online, and she has gone through her entire school career without being corrupted by the collectivist thinking of the public school systems, which are so anti-religion, but that teach religion. They teach the religion of secular humanism, and it's destroying our country.
Good for you. What a good thing to do.
Now, Tom, when you asked that question about the reserve currency, it sounded like it was a two-part question.
Well, number one, I believe that, you know, there's no question we will lose our status as a WRC. And I was interested in seeing what the other guys thought about the timing of that. But let me just give you a little background for my question. I did a whole video on this. It's on ChristianFinancialConcepts.com. But not that many years ago, about roughly 3 decades ago, most of the U.S. debt was bought by U.S. citizens and by U.S. institutions, funds, banks, and so on. So it was about, you know, roughly 60-40, with the 40% being other countries. And then it flipped to where it was about roughly 70-30. Americans were getting wise to the fact that we're so much in debt that this was not really a good investment, and only about 30% of our debt was owned by Americans, and 70% was owned by foreigners. Now, the great majority of our debt is owned supposedly by the Federal Reserve, which is, it's a shell game. That's like me taking $100 out of my right pocket, putting it in my left pocket, and saying I loaned myself $100. So as all this has been happening, the reserves in central banks all over the world, on average, were about 90% USD and 10% gold and miscellaneous currencies. Now we're down to about 60% USD, and most of that other 30% has been taken up with the euro. And there's a tiny amount of the renminbi in the SDRs, so it's really insignificant. People are always saying, "Oh, the Chinese currency is now in the central banks." It's not really. The SDRs are not really currency. They're simply an instrument that countries trade amongst each other, and they did not meet the criteria to be the SDRs, but they used their political clout to force us. So it's just a tiny percentage. So now we're sitting in a situation where 60% is US dollar. And technically, if it drops below 50%, we're no longer the world reserve currency. But one of the thought on that is that there is no such thing as a world reserve currency. Okay.
Tom,
people seem to think that if the IMF designates the world reserve currency, it's simply a matter of function. Whichever this currency the central banks hold the most of at that time, that's the world reserve currency. And we negotiated that back in 1944 at Bretton Woods, but I believe it's soon to end. Go ahead. I'm sorry.
Yeah, I was going to say I've got to jump, and John's probably got a better answer than I do. But the thought that I wanted to share here is what's happened. Again, we forget the problem here. The problem, I mean, in addition to globalism and people trying to take away what we've fought to have for such a long time, that's the real problem. We all have to fight for that. But the problem that's going to happen here, I think sooner rather than later, and the reason that I brought up Deutsche Bank, take a look at that chart, it's DB, is that we've got this debt problem. The problem in Europe didn't go away. The only country that handled that correctly was Iceland. They put some of their politicians and bankers in jail and turned down the IMF loan, and now they're okay. The rest of the people got on the bandwagon, and here's the problem. Let me restate that. Here's the problem as I see it for us. We deal with the Federal Reserve. I hope they end it, and I hope they end it shortly, because the problem with the Federal Reserve is, in order to support their globalist candidate, let me be very clear about that, who happened to win the election in 2008, in order to support that person who came in with a bad economy, they did QE and zero interest rate, which is horrible things both ways. They took the debt and doubled the debt. The debt was out of control, and now it's twice as much. And they ruined people in retirement by taking away interest rates, taking away a value of money. In other words, what's the value of money? Well, it's whatever you pay for it. Oh, well, we don't pay anything for it. Oh, well, there you go. So here's the problem. The Fed used all this to, again, we're going to ask Barack Obama how to save the economy. When he came into office, I don't think he knew the difference between a debit and a credit. So I mean, how are you going to ask him? And then who's he going to ask? Valerie Jarrett. Well, now I feel better. I mean, come on. You get a guy in like Trump, he understands what's going on. Why is he doing well? He's doing much better than the press will tell you. Look up the accomplishments of Trump. There's like 289 of them in an atmosphere where everybody's against him. Here's a guy who understands how the economies work, and he's making it go. These guys knew that in order to puff up the economy, which they had to do so they could dump their assets, is you did this QE. You did it through the Federal Reserve. So anyway, they shot all this ammo out to do that, and now they're in trouble. What's happening? We have a debt problem, don't we? I mean, in other words, we're not making enough as if we were a business, we the United States would be out of business because we're indebted. It takes more money than we make to do that, so we have to sell bonds.
We're bankrupt.
Yeah, we're bankrupt. So we're selling bonds to keep us afloat. Although we look like we're this big power thing, but we're selling bonds to do this. Well, who sells the bonds? Well, essentially the Federal Reserve. Well, guess what's happening right now? The Federal Reserve, are they trying to help us and sell bonds? Well, heck, they had to buy them, didn't they? Nobody else was buying them. They had to buy them. And now what are they trying to do? They're trying to unload what they had to buy. And their job, as I understand it, is still to sell bonds to keep this country afloat. Guess what? There's a big problem there. If we falter and start to go down for whatever, any number of reasons, they're not going to be able to step in and do QE like they used to do it. And if they do, something's going to happen. The dollar is going to fall apart. So you're probably not going to have gold going up. I mean, it may go up because of demand and supply and so forth, but you're probably going to have it going up more because of potential dollar collapse than anything else. But the other thing is
dollar and bank collapses.
And the security. Yeah, I mean, the security thing.
Everything you were saying. Look, I just want to kind of crystallize everybody thinking, just maybe on a parting note. You know, we're all kind of gravitating towards the same thing. We're going to hit a lot of problems in the early 20s. It's almost inevitable, and I'll tell you why. Look, I'm a great, you know, we're all great students of history and the market history, and it is, if you overlay the last century of the 20th century over the 21st century, it's, you know, there's so many things that have happened within a year or two of the same timeline. You know, we had a lot of boundless hope and vision in 1900, and that was the peak of the market. The market crashed into 1903, rallied into 1907. It was a little bit ahead of the current cycle, and then rallied into 1906, 506, had a crash in 07, then had a big rally in the teens like we are right now. But you know what? In 1922, there was a massive retracement that took it back virtually to the 07 lows, the 1907 lows, which would be the equivalent of the Dow coming back to possibly the 2009 lows. So, and I think that what's going on, and look, throughout the teens of the 20th century, we had very steady inflation, almost a similar environment, a kind of disinflationary environment. There was a lot of growth and a lot of prosperity in 1910, 1920. There was huge prosperity in Ireland and England, places like that. And guess what happened in the early 20s? Everybody forgets, but we had the Weimar Republic that devastated Germany. And I think the Weimar, you know, what happened to one country, which was the forerunner of all these inflations, like Venezuela and Argentina and Iran and Turkey and everywhere else, and Zimbabwe, etc., are going to happen to the Western world in the early 20s. And that may be where the U.S. loses its reserve currency status.
John, so, the thing I was going to say before I leave along those lines is that I think that one way or another, I think we're going to have a surprise, and I think that surprise is going to be a new world monetary system. There's one that is available to go and ready, and it's the, you know, with the BRIC nations. I mean, they've got a system already that's ready to go. And that's a, you know, I don't know that, you know, there's whether that's going to be the one that takes over or not, I don't know. But I think the risk to I don't know if it's such a risk, but to me that's the invisible gorilla in the room. I think there's going to be a new monetary system. I mean, history says you collapse first and you scramble to do something like they did with Bretton Woods. Maybe we'll be hard to imagine. I don't know if we're going to be proactive on this thing, but I think that's in the works. And I know there is available money to back that, and that's going to be the one. To me, I mean, I'm very hopeful that happens, because I would much rather see some sort of action taken beforehand, but I realize at the same time to assume that that the intelligent move is done before a calamity happens is just not the way things work in the real world. But I do think that's the one thing that that's going to happen. I mean, we need it today. I mean, we're
and look, it's not
Garrett,
when I say the Western world.
Garrett, before you go, I just want to say one quick thing, and everything. I've really been enjoying talking with intelligent guys like the two of you and Dwayne. This has been a lot of fun today, but I want to say that the underlying problem that's overall the foundation of all the problems that we discussed is a spiritual problem. The United States, more than anything else, has a spiritual problem. It's a Christian nation that's fallen away from God. And unless there's a revival in this country, I don't see any hope for us financially, culturally, or any other way. And I just want to encourage everybody. I've got a video called The God Factor, Why Some Nations Prosper and Others Fail. And I've got actual empirical data that shows why the spiritual condition, or how the spiritual condition of a country affects its financial, cultural, even its health conditions. Interesting.
And Russia is basically a white Christian nation. But by the way, what you mentioned, Christian Financial, and what was the other word, .com?
Christian Financial Concepts.
Oh, Concepts. Oh, thank you. Yeah, I wanted to look that up. Concepts with a plural, right?
Correct.
Yes.
Yeah, I was thinking comments and I couldn't find it, so I was panicking. Anyway, I think you're absolute. That's the number one problem. I mean, the number with all these other.
We're heading there, and it's going to get worse. You know, look, it's already happening in Germany, and the deterioration around the world is palpable, and it's imminent, and it's gone ongoing. But I think it's going to, you know, a lot of things are going to hit. You know, we're going to hit real problems in these early 20s. And then after that, things will get straightened out. I mean, look, it's so like this 87 thing. I have to keep coming back to it. I mean, we had a real shakeout, but remember this, you know, that if you know, they talked about the 15-year plan to fix the U.S. economy. Trump's talked about it. He's certainly he's done an amazing amount in a couple of years in righting the ship and getting us back on track. And hopefully, you know, if he's able to get the next couple of years going right and gets reelected, then, you know, we got a real chance. But there's still going to be problems in the interim. But remember this, after the 87 crash, you know, we had a secondary crash in 1990. It was a small crash, and then we had a 9-year bull market. You know, you got to focus on the bigger picture. We're in a correctional point right now, but we could be in for a huge rebound in spite of everything, especially if the dollar goes. If the dollar gets broken down, it's very bullish for the U.S. economy for the next couple of years, 2 or 3 years, and the whole economy the whole global economy could recover. I think that the Feds, you know, Draghi is not going to let Europe go down. He's going to continue with the QE. He's going to revive it or extend it. The Fed is going to change here pretty soon, and when that happens, it'll be like throwing gasoline on the fire, because it'll be like post 87 again. You know, they're going to prevent a downturn, and there may be enough upside to achieve, you know, a really good number by 2020, and maybe even a 21, 22. But after that, all bets are off, because we just can't. You are definitely we're overdue for something really potentially catastrophic. And this could be a point where you've heard about the 1-to-1 ratio. It only happens once in maybe 60 years or 80 years, where the Dow and gold reach the same price. Well, imagine if the Dow suddenly dips a little bit below 10,000. Okay, maybe gets down to 9 or 8, and gold gets up to 8 or 9,000. There you have it. You have one of these, once or twice in a century kind of an occurrence, and all the ducks are kind of leading to that. You know, the ducks. Remember, we don't know what's ahead, but it could be. You know, there's a lot of reasons unfolding why we could have a really bad correction in 22, and it happened in 1922. and you had the Weimar Republic and everything. You could have the, you know, the collapse of the euro. It doesn't matter if the euro collapses, gold's going to go through the roof because the Europeans will be buying gold. You know, and even if all the currencies collapse. So it's the currency, they cannot maintain this. We're the world's biggest debtor. We've got 22 trillion in debt right now. Probably billions. There's no way out of this short term, what we're in right now. Look, Trump may end up doing 4 trillion in debt, half of Obama, but it's not going to be the end of the world. And, you know, it wasn't the end of the world when gold hit 875 in 1980. It was the beginning of a Super Bowl market that lasted 2 decades. So I think it's really you've got to be undertone bullish, and you've got to take advantage of the volatilities that are coming our way for the future. So,
well, listen, I was going to say thank you so much for allowing me to be part of your conversation. I've got to jump, and this is a. I'm with you, Tom. This is the fun part of my day. It's really great. I'd really love to. We probably ought to set up a time to have where we get together and shoot the breeze a little bit, because this has been awfully enjoyable for me.
Well, we're launching a whole podcast network. It's called Men of a Certain Age. But then we had to cancel that because they already did a TV program by that name. So.
Hey, Garrett, send your contact information through my website, and I'll get in touch with you. Okay?
Oh yes, yeah. In the Christian Financial Concepts, that's the one.
ChristianFinancialConcepts.com. Just use the contact. And John, same thing. I'd like to get in direct contact with you as well.
Great. Thank you very much. Well, listen, Blaine, thank you for putting us together. Thanks for all the invites this year, and to everybody, have a fantastic new year. And if we can, we'll help in any way we can, and good trading and great success to all. And thanks very much for the invite.
Happy New Year, John.
Thank you.
Thanks.
All the best.
Dwayne. All the best to you, Dwayne. Best to you.
Garrett, Happy New Year.
Thanks, you guys.
Happy New Year, and God bless you to everybody. Have a prosperous and healthy and New Year, and let the Lord guide your steps.
Amen.
There you go. That's the one.
Well said. Well said. Thanks, guys.
Bye.
All right, folks. That's going to wrap it up for 2018. Yep. Now, remember, we're going to be gone tomorrow. No markets, no live training room, no radio program. Of course, we stream 24/7, but there'll be no live show tomorrow. Now, when you come back on Wednesday, very important to remember, you will need to register. And your registration should be good this time for 2 months. So, be safe out there. If you're in Times Square, watch out for the drones. I had a drone come and hover over my backyard the other day. I'm sure it was just some kid's Christmas present, but my wife says, "Can I shoot that down?" I said, you know, she said, "It's over my yard." I said, "Well, yeah." I said, "You own the yard, but I'm not sure about the airspace." So we didn't shoot it down. We didn't even throw rocks at it. All right, guys. Thanks so much for
Hey, Dwayne, a quickie here.
Oh, yeah.
Give me a call, and I'll show you how you can set it up to where you have the same link for the entire year.
Okay, I'll do it.
I do that every year.
Okay, I'll do that before we set it up so that we can check. Yeah, all right, sounds good.
Yeah, call me today.
Okay, I will. All right, thanks, Dr. Tom.
Thank you.
All right, guys, it's been quite a year. Another year come and gone. Enjoy yourself tonight. Spend some quality time with your family tomorrow, and you know, and reflect on this coming year. It seems like 5 minutes ago that I was getting ready to watch the New Year's Eve countdown with Fox and Friends in Times Square, and I was in the bathroom this morning staring into the mirror, trying to decide if I'm ever going to shave again, and the jury's still out. But it was that it's that commercial, you know, the one that goes off in your head from time to time, where the guy's just standing there staring into the mirror. how will this coming year be different from you than last year? Or will it? Or is that on your radar? Maybe you had a really great 2018 and you want it to be identical. You don't want any changes. Some do. Some want change. Some need change. We are one nation under God, so talk to him. Talk to him. Whatever it is you're facing, whatever it is you want to change, whatever it is you need to accomplish, these resolutions that we scatter to the winds, I don't know so much as that is the answer, as the answer is talk to God. Maybe ask him what his plans are for you in 2019. Because whatever is on his agenda will most certainly supersede my agenda, your agenda, the agenda of man. So, Happy New Year. I'll see you in 2019. Thanks so much for tuning in. Whoever you are, wherever you are, may God continue to richly bless you with his mercy and with his grace. And I'll see you at the bell.
Remember this, there is no greater return on investment than to see a human life changed and given hope. As always, pray hard and trade safe. Any financial information discussed on this show is simply the opinion of our host, Dwayne Reeves, his co-hosts, and guests. To learn more about trading Emini Futures or to take a 1-week free trial in our live trading room, call 1-866-928-3310. 866-928-3310. Information discussed on this radio program should not be construed as a recommendation to buy or sell any security. Always do your own due diligence and consult with a licensed securities broker or financial planner before making any investment decision.